They got liquidated. A major bank just collapsed. Silver spike. They said it couldn't happen. They said the system was stable. They said the guardrails were in place. But on December 27th, something broke. Silver didn't just rise, it exploded 10% in a single day. Commodities don't move like this, not unless someone is dying. Somewhere in the world, a major institution just ceased to exist. Their computers took over, buying at any price, consuming everything in sight. Gold hit 4,534. Physical dealers went dark. And now, the circuit breakers are armed. When markets reopen Sunday night, we may witness something that hasn't happened in generations. A complete freeze. And what happens next will determine who survives and who gets liquidated. Welcome to Financial Announcement, where we decode the signals others choose to ignore. If you've been following global markets for decades, if you remember what real financial instability looks like, then you understand why this moment matters. We'd appreciate it if you'd subscribe to this channel, not for entertainment, but because the information we're about to share requires your full attention. And please, leave a comment telling us where you're watching from, because what's unfolding right now is happening everywhere, all at once. Let's begin. On Saturday, December 27th, financial markets witnessed an event that defied normal market behavior. Silver closed the electronic trading session at $79.25 per ounce. This represented a single-day gain of 7.34, translating to a price increase of 10.21%. To the untrained eye, this might appear as a strong rally. To seasoned market analysts, it represented something far more serious. Commodities do not move 10% in a single trading day under normal circumstances. When such movements occur, they signal a structural breakdown in market mechanics. This was not a rally driven by optimistic investors gradually buying into strength. This was a forced liquidation event, where a major market participant was compelled to close positions regardless of cost. The mechanics of what occurred are critical to understand. In typical market conditions, buyers and sellers negotiate prices through an order book. A buyer places a bid at one price level, a seller offers at a slightly higher level, and transactions occur when these levels meet. The market moves gradually as supply and demand find equilibrium. This creates the steady price movements investors are accustomed to seeing on charts. But forced liquidations operate under entirely different rules. When a major short seller, a market participant betting on price declines, reaches a critical failure point, their clearinghouse intervenes. The clearinghouse is the financial institution that guarantees all trades and manages the risk of market participants. When a trader's losses exceed their available capital, the clearinghouse assumes control of their account. At this point, human decision-making ends. An automated system takes over with a single directive: close all positions immediately. The algorithm does not negotiate. It does not wait for favorable prices. It simply executes buy orders at whatever price the market will accept. This creates what traders call eating through the order book, where successive buy orders consume all available sell orders at each price level, driving prices sharply higher. The vertical price movement observed on December 27th displays the signature characteristics of this process. The speed was instantaneous. The volume was extraordinary. The price action formed a nearly straight line upward on intraday charts. These are not the patterns of natural market behavior. They are the fingerprints of institutional failure. The timing of this event amplifies its significance. December 27th falls within what market professionals call Ghost Week, the trading period between Christmas and New Year when most institutional traders are away from their desks. Trading volume during this period typically drops to a fraction of normal levels. The order books become thin, meaning fewer buyers and sellers are actively participating. When a forced liquidation occurs during normal market conditions, the deep liquidity of active markets can absorb the shock with less dramatic price movements. But during Ghost Week, that cushion disappears. Each buy order must travel further up the price ladder to find a willing seller. This lack of liquidity transformed what might have been a significant move into a parabolic spike. The entity that failed was not a retail trader managing a personal account. The scale of the price movement indicates an institutional grade position. Individual traders, even wealthy ones, cannot move commodity markets 10% through their buying alone. Only major financial institutions, hedge funds managing billions in assets, or large family offices have positions substantial enough to create this market impact when liquidated. This raises the critical question: which institution failed? Market rules prevent immediate disclosure of specific counterparty failures, but the evidence is visible in the price action itself. Somewhere in the global financial system, a major participant held a massive short position in silver. They were betting that prices would fall. Instead, prices rose beyond their risk tolerance, triggering margin calls they could not meet. The cascading nature of this event suggests this may not be an isolated failure. When one major short position is forced to close, it drives prices higher. Higher prices then create additional pressure on other short sellers who may be operating close to their own risk limits. This creates the potential for a domino effect, where each liquidation triggers the next. The silver market has now crossed a critical threshold. The $79.25 closing price represents an uncharted territory for most current market participants. The psychological impact of breaking through previous resistance levels cannot be understated. What was once considered impossible is now visible on every trading screen in the world. While silver captured headlines with its explosive movement, a parallel development was unfolding in the gold market that provided crucial context for understanding the broader implications. Gold closed trading at $4,534 per ounce, marking a gain of over 1% for the session. In isolation, this might seem unremarkable compared to silver's dramatic spike. However, the significance lies not in the percentage move, but in the absolute price level achieved. The $4,500 threshold for gold represents more than a technical milestone. For years, mainstream economists dismissed this price target as unrealistic fear-mongering. Financial commentators regularly assured audiences that gold above $4,000 was unsustainable, that such levels would only occur in catastrophic scenarios far removed from present reality. The market has now invalidated those assurances. When gold trades at $4,534, it sends a clear signal about the underlying health of the global monetary system. Gold does not rise to such levels because investors are optimistic. It rises because they are seeking safety from perceived threats to currency stability. The metal functions as a barometer of confidence in paper money systems. Rising gold prices reflect declining faith in the purchasing power and reliability of fiat currencies. The relationship between gold and silver provides additional analytical depth. Throughout history, these two metals have maintained a relatively consistent price ratio. While this ratio has fluctuated across different eras and economic conditions, a commonly referenced historical average places it near 15 ounces of silver to 1 ounce of gold. This ratio serves as a useful framework for evaluating whether one metal is overvalued or undervalued relative to the other. Applying this framework to current prices reveals a striking imbalance. If gold is trading at $4,534 and the historical ratio suggests a 15-to-1 relationship, basic mathematics indicates silver should theoretically trade near $3.00 per ounce. The actual silver price of $79.25 represents only 26% of this theoretical value. Even accounting for the reality that historical ratios are guidelines rather than rigid rules, the gap is substantial. This mathematical relationship creates what institutional traders identify as an arbitrage opportunity. Sophisticated trading algorithms continuously scan markets for such discrepancies. When they detect that silver is significantly undervalued relative to gold based on historical norms, they execute large-scale buying programs. This is not emotional investing or speculative gambling. It is systematic, data-driven capital allocation based on statistical regression to mean values. The algorithmic response to this gold-silver divergence has been building pressure in silver markets for months. Computer systems at major trading firms observe gold reaching new all-time highs, while silver remains far below its inflation-adjusted peak from previous decades. The contrast becomes increasingly difficult to justify through fundamental analysis. If both metals respond to the same underlying monetary concerns, why would one surge to records while the other languishes? The answer that algorithms arrive at is simple. Silver has been artificially suppressed and must eventually catch up. This conclusion triggers systematic buying across multiple institutional platforms simultaneously. When numerous large funds reach the same analytical conclusion and begin executing similar strategies, their combined buying power creates tremendous upward pressure on prices. The inflation-adjusted perspective adds another layer to this analysis. Silver's nominal all-time high occurred in 1980 when prices briefly spiked above $50 per ounce during a period of extreme monetary instability. However, accounting for 4 decades of inflation, that $50 in 1980 equates to approximately $185 in current purchasing power. Even at $79.25, silver remains more than 50% below its inflation-adjusted historical peak. Gold, by contrast, has not only exceeded its inflation-adjusted historical high, but continues setting new records. This divergence in performance relative to inflation-adjusted peaks creates a compelling case that silver has substantial room for further appreciation, simply to reach parity with its own historical valuation. Institutional investors recognize this dynamic. When evaluating asset allocation decisions, fund managers compare current prices against historical precedents adjusted for inflation. The data clearly indicates that silver offers asymmetric upside potential compared to gold at current relative valuations. This recognition drives capital flows from various institutional sources into silver positions. The synchronized movement of both metals on December 27th validates that this is not isolated speculation in a single commodity. When gold and silver both surge on the same day, it confirms a broader shift in investor sentiment regarding monetary assets. Capital is rotating out of currency-denominated instruments and into physical stores of value. This rotation reflects a fundamental reassessment of systemic risk. The fact that gold held firmly above $4,500 while silver spiked 10% creates a reinforcing narrative. Gold's stability at elevated levels provides confidence that silver's movement is not a technical anomaly, but part of a legitimate repricing. Institutional traders who might otherwise dismiss a single commodity as price spike as an aberration cannot ignore the coordinated behavior across the entire precious metals complex. Markets operate on precise schedules. Exchanges open. Traders execute transactions. Prices update in real time. And at designated hours, trading halts until the next session. This rhythm creates predictability that allows participants to make calculated decisions. But when markets close at extreme price levels during periods of systemic stress, the closure itself becomes a catalyst for instability. Saturday, December 27th, presented an unusual circumstance. The electronic silver market had closed with prices locked at $79.25. Under normal conditions, weekend closures allow traders time to analyze the week's developments and prepare strategies for the upcoming session. But these were not normal conditions. The 10% single-day surge had caught most market participants completely off guard. As trading screens went dark, the real psychological pressure began building. The challenge facing anyone holding paper, silver positions over this weekend was profound. They possessed contracts representing claims on silver, but those contracts existed within a financial system, showing visible signs of stress. The forced liquidation that drove prices vertical on Saturday indicated that at least one major institution had failed to meet its obligations. This raised an uncomfortable question for every other market participant. Who else might be unable to fulfill their commitments? During regular trading hours, concerns about counterparty solvency can be addressed through immediate action. A worried trader can simply close their position and exit the market. But with exchanges closed for the weekend, this option disappeared. Anyone holding positions was locked in, unable to reduce exposure regardless of how their risk assessment evolved. This created what financial analysts term event risk, where participants face potential adverse developments while lacking any means to respond. The news cycle does not respect market hours. Throughout Saturday and into Sunday, reports began circulating through financial media channels and trading community networks. References to bank insolvencies appeared in overseas publications. Unconfirmed reports mentioned hedge funds experiencing severe distress. Anonymous sources within the London precious metals market suggested settlement failures, situations where parties obligated to deliver physical metal could not fulfill their contracts. The veracity of these reports varied. Some represented legitimate journalism based on credible sources. Others were speculation or deliberate misinformation designed to manipulate sentiment. But verification was impossible over the weekend. Traders could not call their brokers for confirmation. Exchange officials were not available for comment. The information vacuum allowed rumors to circulate unchecked, each report adding to the growing anxiety among position holders. This information asymmetry created vastly different experiences for two categories of market participants. Those holding physical metal, actual coins or bars in their possession or in allocated storage, faced no counterparty risk. Their assets existed independent of any financial institution's solvency. Market closures were irrelevant to them. The metal would retain its physical properties and intrinsic value regardless of what happened to banks or exchanges. Those holding paper claims faced the opposite situation. Their wealth existed as digital entries in brokerage accounts, as futures contracts on exchanges, or as shares in exchange-traded products. Each of these instruments depended on a chain of financial intermediaries remaining solvent and honoring their obligations. The weekend closure meant they could only watch and worry as concerning reports accumulated. This divergence drove a predictable response. Traders holding paper positions began planning their exit strategies. Many decided they would sell immediately when markets reopened, accepting whatever price they could get, simply to eliminate counterparty exposure. This collective decision to exit created the potential for a self-fulfilling crisis when trading resumed. Meanwhile, a separate dynamic was unfolding in the physical bullion market. Retail dealers who sell coins and bars to individual investors operate websites that normally display real-time pricing and inventory availability. Throughout Saturday, these websites began displaying unusual messages. Some showed site maintenance notices, others listed products as sold out across entire categories. Many replaced standard pricing with call for quote instructions. These changes reflected a fundamental challenge facing physical dealers. Their business model relies on maintaining relatively stable spreads between the price they pay for metal and the price they charge customers. They purchase inventory based on current spot prices, then sell it at a modest markup. This works smoothly when prices move gradually, but when prices spike 10% overnight, their entire inventory immediately becomes mispriced. A dealer who purchased coins on Friday expecting to sell them at a $5 markup over the spot price suddenly faced a situation where spot price had jumped $7. Their inventory, purchased at $72, should now be priced relative to a $79 spot, but their website still showed Friday's pricing. Sophisticated buyers would immediately purchase everything available at the old prices, leaving the dealer with losses on every transaction. The rational response was to halt all sales, pull inventory from websites, and reassess pricing in light of the new market reality. But determining appropriate new pricing proved extremely difficult. Should dealers price relative to the frozen spot price of $79.25? Or should they anticipate further increases when markets reopened? What premium above spot would compensate for the elevated volatility and supply uncertainty? Many dealers concluded they simply could not price inventory reliably under current conditions. Rather than risk selling at inappropriate levels, they withdrew from the market entirely. This created a situation where individuals wanting to purchase physical silver found almost no willing sellers at any price. The few dealers still accepting orders were quoting prices near $100 per ounce, a 26% premium over the official spot price. This premium represented more than typical dealer markup. It reflected the complete breakdown of normal price discovery mechanisms. When the spread between paper spot prices and physical transaction prices exceeds 20%, it signals that the two markets have effectively decoupled. They are no longer pricing the same asset. One is pricing a financial claim subject to counterparty risk. The other is pricing actual physical metal with no intermediary risk. Financial markets operate under frameworks designed to prevent chaos. Regulators and exchange operators learned through historical crises that markets left completely unrestricted can spiral into destabilizing extremes. To address this, modern commodity exchanges implement mechanical safeguards known as circuit breakers or limit rules. These mechanisms automatically halt trading when prices move beyond predetermined thresholds within specified timeframes. The CME Group, which operates the primary silver futures exchange, maintains detailed specifications for these trading limits. Under normal circumstances, silver futures can only move a certain dollar amount from the previous settlement price before triggering a limit condition. When prices reach this limit during a trading session, the exchange enters a state called limit up if prices are rising, or limit down if falling. During these limit conditions, no trades can execute beyond the limit price. The stated purpose of these limits is to provide a cooling off period. The theory suggests that forced pauses allow market participants to absorb information, reassess positions, and prevent panic-driven decisions that could destabilize the broader financial system. In practice, however, limit conditions often produce the opposite effect. They create trapped markets where participants desperate to exit positions find themselves unable to do so. With silver having closed Saturday's session at $79.25, the mathematical probability of triggering a limit condition when trading resumes Sunday evening approaches near certainty. Markets closed for extended periods typically reopen with gaps, where the first trade occurs at a significantly different price than the last trade of the previous session. Given the weekend developments, the accumulating news reports, and the building pressure from position holders wanting to exit, Sunday's opening price will almost certainly gap substantially higher. Exchange limit rules function as fixed boundaries calculated from the previous settlement. If silver settled at $79.25 and the limit allows, for example, a $5 move, then trading can continue freely between $74.25 and $84.25. Any attempt to trade beyond $84.25 would trigger the limit up halt. Based on current market conditions and the momentum visible in late Saturday trading, reaching this threshold could occur within seconds of the market opening. When a limit up condition triggers, trading does not simply slow down. It stops completely at that price level. The exchange will not accept any buy orders above the limit price. Sellers can offer metal at the limit price, and if buyers are willing to purchase at that level, trades can occur, but the price cannot rise further regardless of demand. This creates a queue effect where buy orders stack up at the limit price, unable to execute if insufficient sellers materialize. The psychological impact of a limit up halt extends far beyond simple inconvenience. Traders watching their screens see the price frozen at the upper boundary while knowing that true market clearing price likely sits substantially higher. They recognize that the displayed price is artificial, maintained only by exchange intervention. This knowledge that genuine price discovery has been suspended creates profound uncertainty about actual asset values. For those holding short positions betting on price declines, a limit-up scenario represents acute danger. They watch losses accumulate in real time, but cannot exit because the market will not allow them to buy back their contracts. Their accounts face ongoing margin calls, demands from their brokers to deposit additional funds to cover mounting losses, but they cannot close the positions generating those losses because trading has been halted. This creates the conditions for cascade effects when markets eventually reopen. During the limit-up period, traders receive margin calls they must satisfy by depositing additional capital. Those who cannot meet these calls face forced liquidation once the limit expands or lifts. But That forced liquidation, when it occurs, represents additional buying pressure that can immediately drive prices to the next limit level. Thus, one limit up session can spawn another, creating a sequence of trading halts, punctuated by brief periods of frantic buying. Historical precedent provides context for understanding how these scenarios unfold. Previous commodity markets experiencing limit-up sequences have seen price increases of 50 to 100% occur over periods of just days or weeks. The limits do not prevent the ultimate price adjustment. They merely slow it down and, in many cases, amplify the final magnitude by preventing gradual adjustment. The derivative markets linked to silver futures compound the complexity. Numerous financial instruments derive their value from underlying silver prices. Options contracts, exchange-traded funds, mining company stocks, and various structured products all reference silver futures as their pricing benchmark. When the primary futures market enters a limit condition, these derivative markets face their own pricing challenges. An exchange-traded fund that promises investors exposure to silver prices must somehow value its shares when the underlying futures market is frozen. Does it use the artificial limit price, knowing this understates true value? Does it suspend trading in its own shares, preventing investors from buying or selling? Does it attempt to estimate fair value based on physical market prices, which may be 20 to 30% above the frozen futures price? Each option creates problems. Options market makers face particularly acute challenges. Their business involves providing liquidity by offering to buy and sell options contracts at quoted prices. Their risk management depends on being able to hedge these positions in the underlying futures market. When futures markets freeze, their hedging capability disappears. Many will simply withdraw from the market, refusing to quote prices because they cannot manage the associated risk. This withdrawal of liquidity creates additional dysfunction across the entire derivatives complex. The interconnected nature of global financial markets means disruptions in silver trading propagate through multiple channels. Banks that provided financing to participants now facing losses must reassess their own exposure. Prime brokers managing accounts for hedge funds must evaluate whether their clients can meet obligations. Clearinghouses must determine whether they have adequate capital reserves to guarantee all outstanding positions if multiple participants default simultaneously. Regulatory authorities face difficult decisions. They can maintain existing limit rules and allow the market to work through the crisis slowly, accepting that this may take weeks and cause sustained disruption. Alternatively, they can intervene more aggressively by expanding limits, suspending them entirely, or implementing emergency settlement procedures. Each approach carries risks and will benefit some market participants while harming others. The most severe scenario involves the clearinghouse itself experiencing capital adequacy concerns. Clearinghouses stand between every buyer and seller, guaranteeing contract performance. If losses from defaulting participants exceed the clearinghouse's financial resources, the entire market infrastructure faces existential threat. While clearinghouses maintain substantial reserve funds precisely for such situations, the scale of potential losses in a sustained limit-up scenario could theoretically exceed even these considerable buffers. What emerges from this analysis is recognition that Sunday evening's market opening represents far more than a routine trading session. It serves as a stress test for the entire commodity market infrastructure under conditions of extreme volatility and institutional failure. The outcome will demonstrate whether existing market structures can contain and manage a genuine crisis, or whether the frameworks designed to prevent chaos will instead amplify it.